To chapter 22, fiscal policy. Summing up, these are the last few chapters where we recap and cover few remaining pieces about things that we've not discussed. But in a sense, let's tie it together with what are the key takeaways and what's remaining for fiscal policy. The most important piece, if you remember one thing, it would be that fiscal policy can be a strong macroeconomic policy tool, meaning it is useful. When you use it, however, you should think about its impact in the duration that you anticipate. Yeah, so the impact in short run, medium run, and long run would be different. And so know where the intended consequence is for your policy and use it wisely, especially as we talked about in the last chapter during crisis time. This is very helpful. To recap over the last 21 chapters, what we've seen is how fiscal policy has an impact on aggregate demand, especially when you have reduction in taxes or government spending. You start to see that we saw in chapter 3 how it impacts demand and eventually output in the short run. And fiscal stimulus impact on interest rates in the short run on fiscal policy, and fiscal policy's impact on crisis management. Yeah, when you have recessions or COVID crisis, or we've looked at in quite a bit of detail the great financial crisis, um, and we also saw in chapter 9 how the impact of fiscal policy is different in the short run, starts to become much lower in the medium run, and over the long run we see savings and capital accumulation has an impact on the output, right? So fiscal policy and how it impacts expectations was what we saw in chapter 16. How it impacts fiscal policy impacts an open economy, where the economy is open in the goods market, when it's open both in goods and financial market, and how we saw in the last chapter how policymakers um, could have rules that the European Union used that we saw, but it can come with a lot of downsides. And so while they deal with a lot of uncertainty, there are problems that policymakers would want to handle the fiscal situation, but there are issues around time inconsistency and credibility of the central bank, which we saw in the last chapter. This chapter, we're going to cover one last bit, which is so far we've not covered how fiscal policy impacts the budget constraints, specifically the deficit. And is there anything that the fiscal policy takes into account when it thinks about the budget constraint, deficit eventually adding to the debt, and how the spending and tax decisions, increasing or decreasing taxes, are impacted? Yeah, as to how is the policy making some of these decisions. So that sums up all of this area, and we'll focus on this one today quite a bit. Um, yeah, so far we have really just ignored the government budget constraint. So this is what we're going to focus on next. What is a deficit? Yeah, what is a budget deficit? Simply put, for the government, the revenue that comes in is through taxes, and the expenditures that they do with transfers and government spending and in infrastructure and building all of the roads and common goods, those are the expenses. Yeah, if they are able to spend more than what they earn in taxes, then it's running a deficit. Yeah, in a sense, if you think about this as a deficit, as how much of debt you have, deficit in year T is going to be equal to how much of debt you had in the last year. So let's say B stands for the total debt you had, accumulated debt until last year, times how much interest, real interest you will pay on that debt. Yeah. So note this is real interest, not the nominal interest. So this factors in I equals r plus pi, right? So r is equal to I minus pi. So it factors in the impact of inflation. Yeah, so this is real interest rate. So real interest rate times the amount of cumulative stock of debt that you have. So this is your interest payments. Yeah. So deficit this year is how much you will pay in interest this year, plus you will have to pay for the primary deficit, which is how much you ended up spending and transferring to folks, and how much did you end up collecting in taxes. So if you add this up, this will be the new deficit this year. Yeah, this will be the current year's deficit. Interest payments, this is a payment. This is another payment you did, spent the money, and you collected some revenue. So if this is um, positive, then it's a deficit. Yeah. But if it's a negative, then it's a surplus. Yeah. So if net, if you add up all of this and it's positive, it means you paid more than how much you collected, so you run a deficit. So this is important formula, so I'm going slowly. Deficit equals real interest rate times the total debt that you have. So this is your interest payments on the debt, plus whatever you spent minus whatever the money you got as revenue as taxes. We can rewrite this. If I were to state that deficit this year that we added would be equal to, the debt that I have this year minus the debt that I have last year, because the difference between them should be equal to deficit. So debt this year minus debt last year is equal to my deficit this year, right? So the same formula, I've just rewritten this. So change in government debt is equal to deficit this year. So all I've done is replace deficit by change in debt over the last year. Again, I can rewrite this. If I just take bt minus 1 this side, then I can say debt this year is equal to interest payment that I will have over the cumulative debt until last year, plus I will make the government spending and transfers minus taxes. So debt in the year T is something that we can easily derive based on the deficit. Yeah. And so when a government runs a deficit, the government debt increases. Yeah. So if you keep adding deficit after deficit after deficit every year, then that flow of deficit every year is getting added to the stockpile of debt, the debt burden that you have every year. So similarly, if the government runs a surplus, yeah, which is exactly the opposite of what we discussed, then government debt decreases. Here the debt is increasing by this amount. But if it runs a surplus, wherein this number is negative, yeah, it collects more money than what it spends on interest and spending programs, then it's a surplus. So we understand deficit, we understand its connection to debt, and now we also understand how it's related to the real interest rate, yeah, and how much the government spends and how much the government collects. Yeah. So this is super important. So debt in a given year keeps increasing as long as you don't repay back the previous debt using a surplus. You will keep increasing your debt at this rate. And what's interesting to note is that there are two types of debt: official debt, which is in nominal terms, and inflation adjusted deficit, official deficit, and inflation adjusted deficit, which is real deficit. What we see is that since 69 to all the way till, there were several moments where inflation adjusted deficit was negative, meaning it was a surplus in real terms. But the official numbers were always positive, right? Same what we saw in 2022 in a pretty major difference because of high inflation. The headline numbers were around 5.8% official deficit, but We actually had inflation adjusted deficit of a positive 1.8%, meaning we had a surplus of 1.8% because of really high inflation. Yeah, so inflation actually eroded the value of debt. That is huge, yeah, because of negative real interest rate on that debt. That is huge. Yeah, that is huge. So um, that is important to notice as to when these numbers are in, because we care about real terms. Yeah, in real terms, we care about the real terms of our debt, and this happens when inflation is pretty high. It was an unusual year in 2020. After 2020 COVID crisis in 2022, we saw inflation close to north of 8%. Yeah, that's pretty high in that terms. So super important to understand the distinction between official deficit, which is measured in nominal terms, and inflation adjusted deficit. Um, that's another important part. So now let's look at this example of tax cuts, yeah, because that's a fiscal response. And what does a tax cut do in terms of future debt repayment? Yeah, if you, let's say the government decides that they want to do a tax cut this year, at some point they have to pay back whatever the debt they incurred by not getting that tax revenue. Yeah, because they have some spending. So let's imagine that year zero, everything was in balance, meaning you didn't have any debt and you had zero, everything was zero. Yeah? And what you did is on year one, the government decides they want to do a tax cut. And so what happened is they are going to collect less tax revenue. So let's say -1. And that money that they are going to collect through taxes, they are going to raise through issuing debt. Let's say they wanted that money, and but still they decided not to take it from the taxes, but then they issued debt. They issued government bonds, and they now have debt of the same value. Yeah, so they're able to get the money by issuing debt, um, and so that's what they did. If reduction in taxes increases debt, there are several options in which this debt that they incurred can be made zero, or we have to figure out what is the impact of this tax cut over the long period. So the first option um, is, let's say they pay back the debt in the year two. Yeah, in year two they want to pay back, and if assume the real interest rate is R, then they have to pay back 1 plus R. Yeah, because they took debt for a year, 2 minus 1, and so they have to pay 1 plus the interest on the 1. So 1 plus R. Yeah. If in year two they raise taxes, and so they raise taxes such that they not only collected 1, they also collected R percentage, the real interest rate, from the people, then if they pay back, then the debt becomes zero. So nothing, it's all stable and zero and balanced throughout. So that was one of option. If you reduce taxes in year one, in year two you can pay back, but you have to pay back with the interest, yeah, equal to 1 plus R. You could decide that, hey, I cannot pay back in year two. I'll pay back in year 5. So then look what happens. The $1, or let's say this is $1 billion, yeah, $1 billion in taxes that you didn't collect and you raised debt. Now you have this $1 billion of debt that's accumulating interest. In year two, you have to pay back 1 plus R. But if you wait one more year, you have to pay back 1 plus R squared, and so on. Yeah, every year there is a 1 plus R component being multiplied. And so in year 5, if you want to pay back, you have to pay back 1 plus R raised to 4. So that is a much larger amount that you'll have to pay in year 5. And so in a sense, your debt is getting compounded in terms of interest that's being added. Yeah. And so this is whatever the year that you're going to pay, you would have to pay the debt for all those years that you did not pay back that debt. So that is an important second alternative. The third alternative is you decide you are going to reduce taxes of $1 billion, um, and but you don't want this debt to increase beyond one. Remember, in the previous example, this debt was constantly increasing. So what you do is you say, hey, I'm going to collect taxes just equal to the interest rate that I need to pay. So I'll pay back the interest and then the debt remains the same. Pay back the interest, debt remains. So what I did is I charged my people to stabilize my level of debt. I'm going to permanently increase the interest that I'm going to collect through taxes. So my taxes will go up permanently by that R percentage, yeah, the real interest that you would pay in each of these years. So those are your three options. Yeah, you pay back, you take a loan in year one by raising debt for the taxes that you should have collected but you didn't, or you pay back after many years, or you say, hey, I'm never going to pay back the entire thing, I'm just going to keep paying interest. So, and stabilize the debt, meaning the debt level will not go up. Yeah. So those are some of the options that governments have when they decide to do this fiscal policy that says, I'm going to cut taxes. Well, they have to gather more taxes into the future, or much more taxes into the even higher duration time, or permanently increase the tax level. And those are the options that they have. Yeah? And so it is super important to realize this. And as long as the country is doing well and growing, that over time this makes sense. If not, this becomes a compounded problem where the level of debt just continues to grow and grow and grow. Yeah, and you need much higher taxes to correct for it in the future. So while we look at this debt in isolation, it's important to look at it actually from the ratio of debt to output or debt to GDP. Uh, Again, debt is a flow variable, a stock variable, and GDP is a flow variable because every year you calculate GDP. But again, this is important because you just don't want to look at debt in isolation because the country is also growing. So you want to look at that ratio in some sense to know whether the country is actually healthy and stable. So if you want to look at changes in debt to GDP and not just debt alone, what you want to do is start off with the equation that we derived. Remember, we derived the level of debt in the year t is equal to 1 plus r times debt the year ago times spending, transfers, and taxes. Yeah. So we derived this equation earlier in this video, and if we divide this equation by GDP or output, then we can get debt to GDP. So I just divide by YT here, here, we get this equation. If I divide by YT, I get debt to GDP ratio. If I rearrange this a little bit and to factor in that the country is also growing by the factor G, yeah, the country is growing by this factor. So you'd want to reduce that. Yeah? If the country is growing, what should happen is overall that growth will reduce the level of debt to GDP ratio. Yeah. And so if I factor in the growth that the country is having and then rearrange this, what I get is this equation, which says changes in debt to GDP ratio. This is current year debt to GDP ratio, and this is the debt to GDP ratio last year, is a factor of how the real interest rate is evolving, how my country is growing, my debt ratio, and also how much I'm spending. So those are the four factors. So debt to GDP ratio increases when real interest rate increases, growth rate decreases. Yeah, if the country slows down, there's a problem. Initial debt to ratio is high, and and that debt to GDP ratio is increasing. And similarly, primary debt, which is debt not looking at the interest payments, which is spending, transfers, net of taxes. If that is high, then debt to GDP would increase. Yeah. So those are the four factors: real interest rate, growth, initial ratio, and primary debt. So we'd have to make sure that the primary debt to GDP continues to improve as well. Yeah. So we looked at debt, then we looked at debt to GDP because, and we also saw how debt to GDP ratio, which is discussed in the news most of the time, debt to GDP ratio in various countries that are being tracked in the news media channel, that's the ratio that's being used quite frequently. And we saw how debt to GDP ratios primarily were reduced after the wartime in World War II. Primarily, if you look at this, right, because of negative real interest rate. Yeah, this is negative. Again, that reduces the change in debt to GDP ratios. Negative real interest rate drove that. Yeah, primarily because inflation was high in each of these countries. If you look at their primary balances, starting and ending debt to GDP ratio, look at that, 92 to 29, 115 to 59. So almost 2 to 3x reduction in debt to GDP ratio, primarily driven by negative real interest rate. And if we remember, I showed you a chart of 2022, where we also saw adjusted deficit through inflation or through real rate. You'll see that the real interest rate is negative, which causes the debt stock to go down. So debt to GDP ratio will also go down. So now let's look at a new theory called the Ricardian equivalence that we've not discussed so far. This assumes that people, if they realize that they are experiencing a tax cut, right, when they're at point A, and so what they know is that their long-term disposable income will actually reduce. And they also know that the short-term disposable income is increasing from Y1 to Y2, but the long-term is reducing. So it assumes that people know about these fiscal changes in a way that can discount what the future holds, meaning the public savings of the country went down when the country decided to have a fiscal stimulus by reducing taxes. So the public savings went down, but the private savings would go up, meaning that there would be no impact on the aggregate demand. Meaning, if you remember the aggregate demand and the supply curve, point E0 will not move. That's what the Ricardian equivalence proposition is. What we're going to assume is we're going to assume the Keynesian theory where the aggregate demand curve does shift up. Yeah, because the Ricardian equivalence uses a lot of strong assumptions. The first one being that individuals are rational and can anticipate and predict the future with perfect clarity and perfect precision, and that there is good amount of certainty that they have about all of their future payments and taxes, that there is no uncertainty. That's already very hard to predict in these times, right? That things will be as certain or getting more towards certainty. Yeah, and that the capital markets are perfect. You can borrow and lend at the same rate, which is never the case. You have to borrow at a much higher rate than what you lend at. Then there's consumption decisions are based off a permanent income hypothesis. And then they look at their entire expected future income to make current decisions on consumption. And then there's no liquidity constraint. They can borrow as much as they want to adjust their savings and consumption decisions today. Well, a lot of these are very hard assumptions, so we are going to assume that Ricardian equivalence does not hold when we look at all of these fiscal policies and their impact, meaning the aggregate demand does go up in the short run. Yeah. And when we look at deficit, what would be important to look at is cyclically adjusted deficits, which the Congressional Budget Office publishes regularly. If you Google the budget economic outlook for a given year, you will see that it would actually share all of these deficit numbers that are cyclically adjusted. Because remember, the deficit caused by two reasons. There are some automatic stabilizers that get invoked and those transfer programs that get invoked, which has nothing to do with uh, the the fiscal decision that's done, but it's based on the economy. And so, looking at those numbers in that report, you will see that cyclically adjusted deficit gives you a better view of what is happening. Is it the fiscal policy, either expansionary or contractionary policy that's at play, or is it the business activity actually slowing down? Yeah. So, if you want to look at what is actually the driver, you would want to look at cyclically adjusted deficit. Yeah, and these numbers are quite helpful in that sense. War finances are typically done by not increasing taxes, but by actually raising debt. And so, if you see, 1939, about 1% of GDP was used in defense spending, but it went up all the way close to 45% in 1944. And you cannot increase taxes by 50%, and get all of the revenue also as quickly as you want, because it causes a lot of tax distortion. So deficit financing is the way to used in the past for war financing. And when that happens, what we see is that investments go down, consumption goes down, and so capital accumulation is lower. And so that burden is then shifted, the debt burden, because of this larger debt, deficit based financing, and the lower capital accumulation burden is now on the future generations who live after the war to handle that. Yeah. So these decisions, this fiscal decision of using deficit to finance and not taxes, is for that reason. But continuously using deficit is a problem, because if you have high debt, that is an impact of having several years and several decades maybe of deficits. Then that's a problem, because if you see here, this is the bond spread. So zero is, let's say, Germany, and the difference is the percentage. So in this case, 200 basis points, meaning 2%. So Italy expected, around 5% more on its bond. The bondholders who are trying to, or okay to buy Italy, wanted 5% more interest compared to German bond, right? So the bond spread for Italy 5%, and Spain went up to close to 7%, primarily because of high debt. They were running constant deficits, and these countries, there was a fear of default, and especially in the backdrop of Greece's hidden deficit that these countries were close to. So there was a risk associated with that um, potential default. And it only started to improve when Mario Draghi, who's the head of the central bank in the euro area, ECB, who said that they're going to back they're going to back up the Spanish and the Italian bonds with however many needed to buy them, and that they would keep them from not leaving the euro. So they would do whatever is needed, right, um, to prevent the breakup of these countries or have these countries default, right? So expectation is huge, because if there is this spreads increasing, that there's a higher rate of default. So let's learn that default piece a little bit more, as to how higher debt and just keep deficit financing, right? What's the problem? Problem of default. When you default, you are not going to be, your credit ratings of the country, the sovereign credit ratings drop. There's going to be lack of investments, foreign capital, foreign savings wouldn't come, and so on and so forth. So remember, this is the formula we derived together on how the debt to GDP ratio changes year over year. It impacts, the biggest factor is the the interest rate, real interest rate at which you would borrow, the growth rate of the country, which was slowing down in Italy and Spain, and also the initial level, and then the primary deficit ratio, right? So if the debt to GDP ratio is increasing, and that debt is financing that debt is growing at a slower rate than the growth rate of the country, then this debt to GDP ratio will keep increasing. And so that increases the probability of default, meaning this country will not pay back the, the debt, and that gets people to demand higher bond yields. That's what we saw in Italy and Spain, where they had higher bond spread for people to buy those bonds. And so when that happens, when it becomes expensive for them to issue bonds, then the interest payments is going to be expensive because now they have to issue larger yielding bonds, and so the interest payments is high, and so then higher interest payments on those bonds leads to higher debt because now they have to service the debt more. And so if this becomes a debt spiral, eventually this leads to a default, yeah, which is what the risk is if you continue to use deficit and the deficit grows faster than the growth of your GDP, and then it becomes harder for you to service your deficit. And at some point, you would have to do some sort of restructuring. Um, Default comes with also known under different names: debt restructuring, default, debt rescheduling, and various other things. But in a sense, what happens is when this conversation happens, countries are the lenders want the countries to not default, but they take some sort of a haircut where the creditors will um, agree to get back slightly lower value of what they initially were promised, and uh, and then the country continues and hopefully recovers and is able to pay back the debt. Uh, but when this happens, when there is a higher risk of default, what happens is countries start to use money financing, where they will, if the debt is denominated in their local currency, then they'll get the central bank of their own country to print money, and through seigniorage, the profit that's used, which is, this is the difference between the value of the money that they printed minus the cost of printing the money, which is very small. And so they use money financing to actually pay for that debt. As you can imagine, that increases inflation because there's more money pumped into the system, and then eventually leads in many cases to hyperinflation, which is what we saw in many of these countries in the 1900s, and also recently in Venezuela in 2018, where the annual inflation was 80,000%, which is crazy. Yeah, so look at the monthly changes in inflation in each of these countries, which is like huge, right? And the money growth had to be kept up so that the money growth eventually led to the inflation. And then if you look at the prices at time t, last month of when it was hyperinflation to the original, it was like 70 in this case, 10 to the power 10, 10 to the power 27. It's crazy amount of prices. This is insane of what can happen with hyperinflation. So final topic, let's look at what is the situation in the United States. It also continues to have deficit. Look at the total deficit over the last 40 years. It's just negative, 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 negative. And so what we see is a total deficit, and this is the amount that's paid in interest. So this is the primary deficit, right, which is independent of interest. On a given budget year, how much is the deficit? So anticipated primary deficit is expected to improve, but the interest is expanding, which is a big area of concern. So if you look at the latest numbers from what we have right now in February 2025, we see GDP of 27 trillion, but gross debt of 36 trillion. And so that's 135% of GDP. But if you remove the government holdings from the gross debt, you get net debt, which is public debt is about 28 trillion, roughly 105% of GDP. Public debt is more important because government debt can be as long as the government is there. So you would want to look at public debt, which is net debt. And so federal deficit in the last year was 1.8 trillion on the 27 trillion. So that's 6.7% of GDP, which is very high. We are not in wartime, we are not in recession, but that's the deficit we're running under. And we're thinking about tax cuts. So that's a problem. And so what happens is out of the 6.7%, 3% was used in paying interest. And so roughly primary deficit is around 3.7%. So 3% on interest and 3.7% on primary deficit. Historical 50-year average is around 1.7% of primary deficit as a percent of GDP. So this is more than double. So this is an area of concern, right? We are running at primary deficit as a percent of GDP more than 2 times the historical average, when there should not be a need for us to do it that, right? The bigger area of concern is that discretionary spending is only about less than a third of overall spending. 60% is through mandatory spending through Social Security, Medicare, Medicaid, and all those programs. And then the interest percentage is also increasing at a much faster rate. And discretionary spending as a percentage of GDP has gone down much more. If this continues, the interest payments, if it's not stabilized, that's going to double in the next 25 years, which is massive. And then again, this mandatory spending is going to be roughly the same, which is huge because we having a much higher GDP at that time in 25 years. But look at the discretionary spending; it's very small. So you don't have a lot of leverage here. You have to stabilize the debt, which is the biggest part, and you have to stabilize the monetary spending. Yeah. At the same time, you have to actually expand this because you need green investments for climate change situations and investment in green energy and all of that. So this has to actually improve. So all three are in red for us at this point. And we are expecting the monetary spending to continue to grow, right? Close to 6% to 12%, double, which is pretty massive as a percentage of GDP. So these forecasts, if they were to be true, that's a big area of concern. Interest, again, is expanding. Payment on interest servicing on the debt is massive. And where would this money come from? It has to come from taxes, higher taxes. That's the revenue source. So we anticipate much higher taxes into the future. Only then can we stabilize this debt not getting into debt spiral, right? So super important to not cut taxes, but at the same time help reduce the debt to GDP ratio from growing, first stabilize it, and then eventually get it back onto much healthier levels. Because if we don't, what we are also seeing is that the interest rate, which was real interest rate, which was constantly going down over the last 30 years, and it was negative until 2022, it has started becoming positive and much higher. It's now at 2.3%, 2.03%, meaning this R is going to go up. If it goes up, the debt to GDP ratios will go up, meaning people are no longer giving America are okay with lower interest rate for a 10-year bond in the United States versus now they want much higher interest rate, right? Because they anticipate that things are not as safe anymore, right? Meaning they need to be compensated for the risk. So the borrowing costs are going to go up, and if the only thing under our control is the growth, if the growth slows, then this whole thing will become a mess. And so you cannot, if the growth slows, you cannot tax more. So you have to stabilize the debt GDP ratio. You have to stabilize the taxes, increase the taxes, and you have to stabilize the interest payment. Otherwise, this becomes a huge issue. Yeah, cannot be running primary deficits and cannot be spending too much money because we don't have it, because it's going to become bigger and bigger problem. Financial policy, if you remember one thing, it's super important. We cannot be deficit financing our way out. We have to stabilize, get our investments expanded for the green investments that are needed. We have to stabilize the monetary spending and get back towards a healthy state. And we can do this if we really deeply understand what policies are impacting us in the short run, medium run, and the long run. Yeah? Thanks. Hope that was interesting. Next chapter is going to be even more interesting. We're going to summarize the monetary policy. So that's going to be even more interesting. So I'll see you then, and thank you. Bye.